People often ask me where the real moves begin, and I tell them the truth. The market whispers the answer long before the crowd ever hears it. And before we get into today's idea, let me tie it naturally to something familiar, just like we talked about in the previous video on simple but powerful trading rule. The market rewards the trader who learns to see what others overlook. Now, let's talk plainly. Most traders chase the obvious. They watch price dance along the surface and think they're seeing the whole picture. But the levels where real breakouts begin, the levels that matter, the ones that start the genuine pushes, those are hidden. Not hidden because the market is trying to trick you, but hidden because most people refuse to study the behavior of price deeply enough. Tell me, have you ever watched a chart and felt like the real move happened just when you stopped paying attention? That's the nature of these buried levels. When I traded in my early years, I learned that the market speaks in habits. It returns to certain prices like an old friend, tests them, walks away, then comes back again. And every one of those returns is a clue. A trader who studies these zones with patience, not obsession, just steady observation, starts to understand where the pressure sits. Do you notice how price often hesitates at the same spots, even when the news is loud and the crowd is restless? That hesitation is your first hint. A hidden level isn't magic. It's simply an area on the chart where buyers or sellers once showed conviction. The chart never forgets conviction. People do, but charts don't. And if you've ever gone back to old trades and wondered why the breakout happened 10 cents above or below where you expected, ask yourself, were you watching the last obvious level or the one built quietly beneath it? You see, most traders only look at swing highs and swing lows, but the meaningful levels often come from failed moves, shallow pullbacks, small clusters of candles that reveal more intent than they reveal distance traveled. Ask yourself this. How often do you study the places where price almost moved but didn't? Those nearly forgotten attempts hold more information than the big, dramatic highs everyone sees. A real breakout doesn't begin at the breakout point. It begins at the level where smart money first defends, accumulates, or distributes. That's the ground floor. That's where the trader with patience and memory gains their edge. And if you want to build wealth, slow, steady, disciplined wealth, you need to be the trader who notices these subtle footprints. Have you ever watched price coil near a level for hours or days and felt like something was building beneath the surface? That sensation is your intuition recognizing stored energy. Now, let me remind you of something that ties back to what we talked about in the previous video on simple but powerful trading rule. The market rewards consistency in reading behavior, not in making predictions. Today's principle about hidden levels is just another way of saying that consistency beats impulse. Every level you identify is a test of your discipline, not your intelligence. A hidden level shows itself through repetition. Picture a price area where the tape slows, where volume hums instead of roars, and where the movements shrink like the market is catching its breath. That sort of spot can look insignificant, but it's often the foundation of the next major leg. You've seen it before, haven't you? A market that looks calm, then suddenly tears through a range like it never cared about stopping. But beneath that burst was a quiet level where the real story began. The market rewards the trader who pays attention to these quiet moments. That's why I often asked myself during trades, is the market revealing strength or hiding weakness here? You'd be surprised how often that simple question clears the noise. The crowd trades the breakout. The professional trades the structure before the breakout, and structure always forms around these subtle, hidden areas. Many traders lose money not because they misread the direction, but because they misread the starting point of the move. They enter too late or too early because they didn't watch where the market built its base. Wealth in trading doesn't come from hitting home runs. It comes from consistently entering at levels where the risk is small and the idea is clear. And where are those opportunities born? At these hidden levels that quietly hold the market's intent. Think about your own charts. How many levels do you mark? 10, 20. And how many of those levels actually matter? Probably only a handful. The key is learning to identify which ones contain pressure. You can tell because price reacts there not once, but repeatedly. Maybe softly the first time, maybe more sharply the second. Do you ever get the sense that price is nudging a door to see if it's locked? That's what these tests are. Nudges before the burst. I learned early on that if a level has held 3 or 4 times, and price keeps returning with slightly less hesitation, the breakout won't start at the obvious top. It'll start the moment the hidden support or resistance gives way. That's the moment when the smart money says, now. And if you're waiting at the surface, you'll miss the tell. Traders often think mindset is a separate matter from chart study, but the two are woven together. A trader who understands hidden levels naturally develops patience. You don't rush into a market when you know the starting point hasn't formed yet. You wait. You let the level reveal itself. You build your position like a carpenter fitting joints. Not hurried, just precise. Tell me, do you ever feel like eagerness pushes you into trades sooner than your plan intended? When you build this discipline, you're not just learning charts. You're training yourself to think like the market. The wealth building mindset in trading isn't about dreaming of big wins. It's about letting the market show you where the real opportunities gather, and hidden levels are where those opportunities take shape, piece by piece, until suddenly the pressure releases and hidden levels form where price quietly builds pressure long before the obvious breakout, and that single idea explains more about real market movement than most traders ever learn in their first few years. When you look at a chart, what you see on the surface is only the final expression of a story that's been building underneath. Most people chase the breakout candle, or the sudden spike, or the loud move. But if you trace that move back to its origin, you'll find that it didn't begin at the moment of explosion. It started much earlier, in an area so subtle that most traders never notice it. That's the hidden level, the birthplace of the real breakout. Picture a market drifting sideways. Nothing dramatic, nothing flashy. The candles are small, the volume is steady, and nobody on social media is talking about it. These are the moments when inexperienced traders tune out, thinking nothing important is happening. But if you've trained your eye, you understand that the market is never neutral. Even in stillness, pressure is building. Price is negotiating, debating, and measuring the strength of buyers and sellers. And if the same price area keeps showing up again and again, that's your first clue. Have you ever noticed how a market can return to a level quietly over and over without anyone paying attention? That's the soil where real breakouts grow. The build-up of pressure at these hidden levels is rarely loud. It's not a dramatic rejection or a bold reversal. It's more like a subtle leaning, a slight hesitation each time price approaches that zone. Maybe the candles shrink. Maybe the wicks shorten. Maybe the tape slows just a fraction. These details are small, but to a trained trader they're signals. The market is telling you, watch this area, something is forming. And those who ignore these whispers often end up entering too late, chasing after a move that began long before they even realized something was happening. Pressure forms at these zones because markets remember. A price area where significant buying or selling once took place becomes a point of interest, even if the chart looks quiet. Institutions, funds, large players, they accumulate slowly, carefully, and without drawing attention. They can't simply rush into the market like retail traders do. They have to build positions in silence. And that silence is exactly what creates the hidden level. Price doesn't need to spike for pressure to build. Sometimes the strongest levels are the ones where nothing seems to be happening at all. Have you ever wondered why the market suddenly erupts after hours of calm? It's because that calm wasn't emptiness, it was preparation. At a hidden level, you'll often see a battle, but a quiet one. Buyers hold their ground. Sellers test the area. Price ticks back and forth, but the reactions become slightly more decisive each time. Maybe buyers are stepping in just a bit earlier. Maybe sellers are being absorbed more quickly. These subtle shifts create tension, like a bowstring being drawn. When that tension becomes too great, the bow releases, and that release is the breakout everyone sees. But the true opportunity was in recognizing the tension as it formed, not in reacting to the arrow once it flew. Traders who understand this concept develop a different kind of confidence. They stop reacting to the surface, level moves, and start studying the structural ones. They know that a breakout isn't a surprise event. It's the natural outcome of pressure that has been building. And when you can see that pressure forming in real time, you gain an edge that most traders never develop. Instead of guessing when the move will come, you wait for the signs that the level is maturing. You wait for the quiet tests, the small rejections, the steady compression. You wait until the market shows that it's preparing to choose a direction. And by the time the breakout arrives, you're already prepared. This understanding also sharpens your risk management. When you know where the pressure is building, you know exactly where your idea is invalidated. Hidden levels provide clarity. They show you where buyers or sellers are drawing the line. A good hidden level gives you a clean, logical area to place your stop and a well-defined justification for your entry. You're not gambling on hope, you're acting on structure. And building wealth in trading isn't about hitting dramatic wins. It's about consistently positioning yourself where the risk is tight and the logic is strong. But here's the interesting part. Hidden levels look boring. They look unimportant. That's why most traders ignore them. They want excitement, clear signals, loud reactions. Yet the market doesn't reveal its intentions through noise. It reveals them through calmness. A hidden level isn't supposed to look spectacular, it's supposed to look ordinary. That's why it works. Have you ever noticed that the setups with the least drama often produce the cleanest moves? That's because the pressure was building quietly, under the radar, long before the breakout ever showed itself. Repeated subtle tests of a price zone reveal where smart money is active, and understanding this single principle can change the way you read a chart forever. Most traders focus on the dramatic moments, the big candles, the spikes, the sudden moves. But the real story of a breakout begins much earlier in these quiet, almost invisible tests. Price keeps coming back to the same level, not because it's lost, but because something important is happening beneath the surface. The market is probing, gauging strength, and revealing where meaningful orders are sitting. Have you ever watched a level get tapped over and over and wondered why the market keeps returning there instead of choosing a direction? That repeated behavior is exactly where your attention should be. When buyers or sellers with size are involved, they rarely show their hand in a single move. They build positions carefully, consistently, and with patience that most retail traders never practice. They don't chase candles, they accumulate or distribute over time. And the way you can spot their presence is by noticing how price reacts when it revisits the same zone. The reactions aren't explosive. They're controlled, measured, almost delicate. The market nudges the level, steps back, and then nudges it again. Each test is a signal that someone with influence is waiting there. And the more subtle the tests, the more likely you're looking at the fingerprint of smart money. Think about the difference between retail traders and large players. A retail trader can enter with a click and be filled instantly. A big player can't. They need liquidity, real liquidity. They need to spread their orders across time, sometimes across days, and they need price to keep visiting the area where they can quietly transact without causing a scene. That's why repeated tests of a zone are so telling. The market keeps returning because someone wants it there. The zone becomes a meeting place where supply and demand quietly negotiate. And if you've ever felt like a level was being held on purpose, you're not wrong. It often is. Each test provides clues. For example, if price taps a support level and the bounce becomes slightly stronger each time, that's a sign buyers are gaining confidence or size. If price tests resistance and gets rejected faster and with smaller pullbacks, it may mean sellers are quietly reinforcing their position. These are small signals, but small signals often reveal the biggest intentions. Have you ever noticed how a breakout feels obvious once it finally happens? That's because all the subtle testing leading up to it was already showing you where the important players were positioned. The subtlety is what makes it powerful. Big traders don't want to push price too far away from their entry zones because that reduces the liquidity they need. So they work the level instead, letting price drift into it again and again. Each touch adds information. Does the level hold quicker than before? Is the tape slowing when it arrives? Are the wicks shrinking? This behavior is the market's way of hinting that a decision is approaching. Most traders miss these signals because they're waiting for something flashy, but the best signals are usually the quieter ones. As these repeated tests continue, something else begins to happen. Tension builds. The more often a level is tested, the more participants are aware of it, consciously or not. Some traders place stops below or above that zone. Others place pending orders. The area becomes charged with activity, even if the candles look small. Smart money thrives in this environment because they can use the repeated visits to fill or exit their positions without attracting too much attention. But the observant trader, someone who watches the behavior, not just the shape of the candles, can see the pattern forming long before the breakout occurs. Once you understand this, your approach to entries and exits changes naturally. Instead of chasing breakouts, you start studying the levels that are being tested repeatedly. You recognize that the market is showing you where the real interest lies. And if you focus on those areas, you find opportunities where your risk is controlled and your understanding is sharper. Have you ever entered a breakout only to be faked out immediately? That usually happens because you watched the final act instead of the build-up. The repeated tests were the clues you needed to see. A price level tested once doesn't tell you much. Tested twice, it becomes interesting. Tested 3 or 4 times with diminishing hesitation or increasing absorption, and now you have something real. These multiple tests reveal the intentions of the participants who matter. They show that someone is willing to transact repeatedly at that price. And wherever consistent interest exists, breakout potential eventually follows. But recognizing that potential isn't about predicting, it's about observing. This principle also nurtures discipline. When you learn to watch repeated tests, you stop forcing trades. You let the market show you what it wants. You develop patience, because you start to understand that the best moves aren't spontaneous, they're built. And as you observe these subtle tests, you begin to recognize patterns in your own behavior too. You stop reacting to every wiggle and start responding only when the structure aligns with logic. Repeated tests also give you insight into the strength of participants. If price keeps returning to a level but refuses to break it, that shows commitment. It shows that one side is defending with purpose. And when that defense finally cracks, the resulting move is often smoother and cleaner because the build-up of orders has been resolved. These are the breakouts traders dream about, yet they are born not from sudden surprise, but from prolonged preparation hidden in plain sight. There's something almost rhythmic about these tests. The market moves like it's breathing. Inhale, exhale, return to center. That center is the level being tested. With each breath, more information is revealed. And if you develop the habit of watching this rhythm carefully, you start to see what most traders overlook. You start to see where the smart money is quietly putting their weight down. And once you can see that, you begin trading from a different vantage point entirely. True breakout zones rarely look dramatic. They often look boring or insignificant. And that simple truth is one of the biggest reasons traders miss their best opportunities. Most people come into the market expecting excitement. They want fast moves, big candles, flashy signals. They want the chart to scream at them, "Here! This is the moment!" But the reality is that the market almost never announces its intentions with fireworks. The beginnings of major moves are usually quiet. They look plain, even dull. Have you ever stared at a chart and dismissed an area because it didn't look important, only to watch price explode from that exact level later? That's the nature of real breakout zones. They hide in the ordinary. The human mind is wired to pay attention to extremes. Big highs, deep lows, huge candles, sudden spikes. Those things draw the eye instantly. But the market's most meaningful structures don't live at the extremes. They form in the flat, calm middle. They take shape during the times when most traders are distracted or disinterested. Breakout zones are born in the small retests, the quiet consolidations, the low volume pauses. And because they look unremarkable, the majority of people ignore them. They mistake quietness for weakness. They assume nothing meaningful is happening. But quietness is not weakness. In trading, quietness is often preparation. Smart money doesn't want to create noise. Noise brings attention, and attention creates competition. So the players who move size operate in silence. They accumulate positions slowly, often at levels that look too ordinary for retail traders to care about. They let the market drift sideways, tapping the same area lightly, testing liquidity, absorbing orders. Nothing about this looks dramatic. If anything, it looks dull. But beneath that dullness is the transfer of position, the build-up of pressure, and the formation of a foundation strong enough to support the next major move. Have you ever felt tempted to skip a setup because it lacked excitement? That might be exactly why it was valuable. The lack of drama is precisely what makes these zones trustworthy. Big flashy levels attract the crowd, and wherever the crowd gathers, the market becomes unstable. Noise increases. Emotions flare. Liquidity becomes distorted. But in the quiet zones, where price moves slowly, where candles shrink, where volume hums instead of spikes, the market reveals its real intentions. These are the places where supply and demand settle into agreement. These are the places where the tug of war starts leaning in one direction, even if the chart hasn't shown it yet. Think about what a dramatic spike actually represents: a reaction, a response to something that's already happened. The spike is the consequence, not the cause. The cause is the boring structure beneath it. That structure, that slow build-up, is where the breakout truly begins. And if you want to trade the start of moves, instead of chasing the end of them, you need to become comfortable studying these quiet, insignificant-looking zones. They are the fingerprints the market leaves behind before it reveals its plan. The boredom of these areas also plays into your psychology. Traders who crave excitement often lose money because excitement clouds judgment. It speeds up your decisions. It makes you react instead of observe. But when you learn to value quietness, your entire mindset shifts. You start approaching the market more like a craftsman than a gambler. You start looking for structure instead of noise. You begin to understand that wealth in trading is built not from thrilling moments but from disciplined, repeated observation of subtle patterns. These unremarkable breakout zones often share similar characteristics. The candles become compressed, the range narrows, volatility contracts, volume levels off and becomes steady. Price doesn't rush anywhere, it drifts. These are all signals of equilibrium, of balance, and balance is what precedes expansion. The market spends most of its time in balance. Only occasionally does it break out of balance, and those moments of imbalance are what traders chase. But the foundation of imbalance is built during these calm periods. Have you ever noticed how explosive moves often come right after a stretch of dull, sideways price action? That dullness was the coiling of energy. When you begin recognizing these subtle environments, you gain the ability to anticipate high-quality moves before the crowd sees them. Not predict. Anticipate. You're simply reading the conditions that lead to strong moves: contraction, quiet tests, subtle absorption. None of these things look exciting on the chart. If anything, they look like the market is asleep. But it's not asleep. It's accumulating power. Another reason breakout zones are boring is because the market doesn't want everyone on board. If the level looked too obvious, too powerful, too clean, too textbook, then every trader would place an order there. And when everyone piles in, the move becomes messy or fails. But when the level looks boring, when it looks like nothing special, it filters out the impatient traders and keeps only the observant ones. That's exactly why the cleanest breakouts begin from zones that feel almost invisible in real time. Over time, you start to appreciate these quiet zones. They become your hunting grounds. Instead of looking for excitement, you look for stillness. Instead of chasing big candles, you study the small ones. Instead of waiting for thrills, you wait for structure. And the more comfortable you become with boring, looking areas, the more consistent your trading becomes. Because consistency doesn't come from reacting quickly. It comes from recognizing quietly developed opportunity. The real edge comes from spotting the base of a move, not the breakout point itself, and that single shift in perspective can transform the way you trade. Most people chase the obvious. They wait for a dramatic candle, a sudden surge, a loud signal from the chart telling them, now is the time. But by the time those flashy moments appear, the real opportunity has already passed. The traders who consistently pull money from the market are not reacting to the top of the move. They're identifying the quiet foundation that formed beneath it long before the crowd woke up. Have you ever wondered why some traders seem to catch the move early while everyone else is left chasing it? That difference comes down to recognizing the base, not the breakout. A breakout is simply the public reveal of a decision the market already made. The energy behind the breakout didn't come from that final candle. It came from hours, days, or sometimes weeks of subtle price action building pressure. The base is where the tug of war between buyers and sellers is fought quietly. It's where smart money positions itself. It's where size is accumulated or distributed slowly without attracting attention. And because the base is slow and often dull looking, most traders ignore it. They want excitement. They want the part of the story where the market moves fast. But the truth is that fast moves only happen because slow moves prepared the ground for them. When you start focusing on bases, you begin to see the market in a completely different way. Instead of asking, where will the breakout be? You start asking, where did this move begin forming? Those two questions lead you to entirely different parts of the chart. The breakout is the end of the preparation. The base is the beginning. And beginnings are where the best trades live, because that's where your risk is smallest and your clarity is greatest. Have you ever noticed how entering late feels stressful, but entering near the base feels controlled? That's because the base gives you structure, while the breakout gives you chaos. A base forms when the market is in balance. Price starts moving in a tight range. Volatility contracts. The candles shrink. Volume becomes steady instead of erratic. These may look like insignificant details, but to a trained eye, they're the signs of a market preparing for expansion. Large players can't enter with a single click. They need time to position without drawing attention. So they work within these tight zones, letting price revisit the same small area again and again. It's not random. Price keeps returning because someone is slowly building or unwinding size. That's why the real edge is found there. The base shows you where the meaningful interest is. If you observe carefully, you'll notice signs of accumulation or distribution, repeated tests, slight absorption, subtle shifts in how candles behave, diminishing pullbacks, controlled reactions. These are hints that one side of the market is quietly gaining the upper hand, and once that balance tilts far enough, the breakout becomes inevitable, because the groundwork has already been completed. This understanding changes not only how you trade, but how you think about trading. It encourages patience. It forces discipline. You stop needing constant action because you realize the best setups are forming while nothing dramatic appears on the screen. You learn to appreciate the moments when the market seems quiet. That quietness is where your edge lies. It's where you begin planning your trade instead of reacting to someone else's move. Have you ever caught a breakout only to see it reverse instantly? Traders who focus only on the breakout point often fall into that trap because they didn't understand the base behind the move. When you trade from the base, you're trading from understanding rather than excitement. Your entries become cleaner because you're catching the move before the herd piles in. Your stops become tighter because the structure gives you clear invalidation points. Your mindset becomes calmer because you're acting on preparation instead of adrenaline. And over time, the quality of your trades improves not because you're predicting better, but because you're reading the market's foundation instead of its surface. The base also reveals the type of breakout that's likely to follow. A clean, stable base usually leads to a smoother breakout. A messy, erratic base often leads to choppy movement afterward. This is information traders miss when they only stare at the breakout candle. They're looking at the loudest moment, not the most informative one. The breakout candle tells you what happened. The base tells you why it happened and how strong it might be. Another advantage of studying the base is that you become comfortable with waiting. Most traders treat stillness as a void. They think nothing is happening. But in trading, stillness is often structure forming. It's the calm before the move, not the absence of opportunity. Once you understand that the base is where the edge lies, you stop forcing trades in the middle of noise and start watching for the moments when the market is quietly laying down the pieces for the next directional push. That shift alone can improve your performance more than any indicator or signal ever could. Over time, you'll notice something powerful the more attention you give to bases, the less FOMO you feel during breakouts. You won't worry about missing a move because you'll know that the next opportunity is already forming quietly somewhere on the chart. You'll look for contraction, for compression, for quiet pressure building. You'll look for the parts of the chart that most traders overlook because they look too ordinary to matter. And that's exactly where your edge is.